Let's continue to the debt repayment schedule and the cash sweep. We haven't finished it, the free cash flow, the calculation and projection model, because the interest expense is calculated based on the update of this debt amount every year until up to the projected years. So here, the debt repayment is comprised of the interest rate assumption and the debt balance after mandatory debt repayment, using some amortization according to the characters of each debt tranche. And then we get this excess FCF, free cash flow available for optional the debt repayment. And then debt balance after optional debt repayment is calculated like a cash sweep 100% from the FCF, and then total debt remaining balance. And then after this, we calculate the net debt amount after optional debt amount if we have some clause or provisions. And then the credit statistics projections, understanding the leverage effect and the coverage effect. So let's begin. Here, we assume the LIBOR, the London Interbank overnight rates. Overnight rates, the average 6 months has like 2%, 2001. This is 2021 or 2022 recent has been increased because of the inflations. And then this is again the assumption part, right? I assume that this inflation will be the increasing and then the stabilize and the downturn after 2 years. So 2% and 1%, for example. And then we calculate average value of the LIBOR, because when you calculate the debt amount interest expense, this interest expense is updated by the 6 months, right? The 6 months. So we use this the interest rate calculation for the average value. Again, why do we need this? Because we are going to use this LIBOR into the inflation, into the interest rate of the term loan B, right? 2.5% of this percentage, right? So the LIBOR, the average, is just average of the recent 2 years. Then let's just drag. And then we have, if there is the floor means it's kind of provision or some clause that this term loan 2.5% plus at least the certain the LIBOR the interest rate, which is floating rate, should be not below this percentage, right? So now we got it. Now let's develop the debt balance after mandatory debt repayment part. So the source amount we get from here, the section B, right? Also, we collected all this number of senior notes or junior subordinate notes. At the same time, we have the total amount not changing because it's just on the inception year, right? Now we have to get this source amount. Now how to get it? This amount will be now the 1% every year. 1% is decreased by the mandatory percentage, at least the 1%, right? Because usually term loan B, the category has like 1% very minimum amount of the repayment, mandatory. And if there is some clause, this term the loan B requires to repay the 100% of the free cash flows generated from this business, right? So 1% is just the minimum, right? So let's use this 850, right? Then minus 850 times 81, right? This one. But we will develop this. We'll develop this 850 after the payment. So let's just use this number after this, the mandatory debt repayment. So let's use this number. And then let's get fixed. So every year based on the initial, the borrowing amount, right? Initial debt times 1%. Then got it. So 820. Then this senior note doesn't have the repayment. Let me just, this also doesn't have the repayment. So let's just drag to the right. The same way after the mandatory debt repayment. Also, the senior notes and junior subordinate notes doesn't change. So let's just drag to the right. Now let's calculate this. Next here, how to get this 2022 excess amount, how to get it. That's the point we want to figure it out, right? It's here. Now this term loan B, this amount is a starting point, right? 81 term loan B, this is the starting point, and then minus, now that's what we want to collect, right? That's what we want to collect, times, now here 100%, which is fixed if this company generate the free cash flows, right? So let's just fix this. So how to calculate this excess free cash flow available for optional debt repayment? This is equal to, now that's what we calculated, right? Then minus this term loan B, but we need to fix, and then what is the percentage? Right, 1%, fixed. So this is the mandatory, right? Mandatory. So let me just drag to the right so that all these numbers, now the free cash flow available, right, before optional debt payment is calculated, right? The mandatory, the term loan repayment, right? Again, this is not the correct one. We need to calculate interest expense anyway here. And then term loan B, how to get it? Term loan B now is calculated again. Once we got this new number, then we need to calculate here the same way, right? We need to develop this. All the way down to the right. This number also we needed to now get it. But again, we need to get this interest expense. How to get this interest expense? Interest expense is calculated time the debt balance, right? Each debt tranche. So this debt tranche right? Times. Now we need to get the interest, right? This 2.5% will not change it, right? Then we need to add interest average 6 months, right? But it doesn't the fixed, because we have to drag it to the right each year. And then plus next is a senior note, right? And then now multiply by now 10%, right? Fixed. And then finally this amount times 12%, which is fixed. Then we have this interest expense. Now let's just drag to the right. So we have all this, the interest expenses. Interest expenses now. Then we also have the free cash flows here. Then total debt remaining balance is just the sum of all. Then let me just drag it to the right. And then we have now total amount of debt remaining balance. If we have another assumption for the optional, the debt repayment, you have to put any number, but let's just make it simple for me. If you guys have some assumption, definitely you can put some other repayment here for the optional. So, but for this case, just let's make it simple. Net debt is just this. Minus, and we have a net debt amount have it calculated. Is that correct? Right. So let me double check if I have all the numbers correctly calculated. Okay. Then the credit statistics projections. Credit statistics projections is explaining the each ratios, right? How the leverage of this each ratios has been changed, and then you explain on your Word file, right? So the net debt is where is net debt? Net debt, here we go, divided by Ebitda. Ebitda on here, right? On the free cash flow projection. This leverage effect has been decreased, right? Because the net debt amount has been decreased. Also, the Ebitda has been increased, right? The senior secured debt amount over the Ebitda. So, senior secured debt or the term loan B, right? So we want to see the actual remaining, the leverage of the repayment, right? Divided by also the Ebitda. It definitely has been decreased, and then only 0.05 is the remaining ratio, right? Because as you can see here, only $25 million out of 850 is the remaining. And then we also want to see the ability to pay the interest, which is coverage ratios. How do we calculate? Ebitda is the ability to pay the interest in cash, and then divide by the interest expense. There you go. So 4 times ability to pay the interest now has been increased, right? because the interest amount expense decreases along with the decrease in the debt amount. We want to actually the precise amount of the coverage ratios after the capex, capital expenditures, right? Also, we can calculate Ebitda minus capex. Where's capex? There you go. Capex required to grow the company, right? Divided by now interest. Because capex is a huge amount of the payment, so it also has been the increasing. That means the coverage ratio has been better, right? Getting better. That explains the financial, the ability of the company, and then avoiding some insolvency issues. Okay, now once we created this section 4, we will come back to the exit years multiple for the transaction assumption part, and then we'll complete the sensitivity tables next video clips. You guys, bye bye.